Hello and welcome to the second video for Accounting 205 Chapter 7. I'm going to start now on page 7-5, and this will be the main subject of this chapter, and we're going to talk about depreciation. So we're going to break this up into probably 2 or 3 videos. Alright, the term depreciation does not mean like the write down of an asset. What it means is it's the allocation of an asset's cost over its useful life. All right. Now, one difference between accounting 101, financial accounting, and tax depreciation is this. The IRS assumes that there is no residual value. All right. That's the default. So if you want to enter a residual value, meaning the value that the asset will be worth at the end of its useful life, you actually have to enter that as part of the calculation inside the software. All right. Otherwise, the percent of business use is always assumed to be 100%. Okay. So let's take a look at depreciation. All right. There are several types of tax depreciation that we have. All right. So I want to go over some of these with you. All right. If you take a look at the top of page 7-7. All right, you will notice that they talk about recovery periods for assets placed in service after 1986. Okay, prior to the Big Tax Reform Act that we just had in December of 2017, the last major tax reform act that we had was in 1986, and that was the year that we came up with the Modified Accelerated Cost Recovery System, commonly known as MACRS. All right. Under MACRS, assets are divided into asset lives, all right, as shown in table 7.1 on page 7.7. Okay. Those recovery periods or class lives are 3-year, 5-year, 7-year, 10, 15, 20-year, and then the two that are reserved for real estate only, and that's 27.5 years for residential real estate, meaning that you rent it out to, your tenants, or 39-year for non-residential real estate like an office building. Okay. So there is something else in MACRS, okay, that is called a half-year convention. A half-year convention, okay? Under MACRS, all right, the tables that are set up for you, all right, and these tables are at the top of page 7-8, okay, all right, and also on the top of page 7-10, okay. These are tables that are set up assuming that you use a half-year convention. A half-year convention means that the asset is placed in service at the midpoint of the year, regardless of when it was actually placed in service. Okay, so take a look at the example at the bottom of page 7.7. Okay, all right. What you would do here is you would use, for example, this example for a 5-year asset. Okay, so let's go ahead and look at that example, and we're going to use table 7.2 at the top of page 7-8. Okay, so the taxpayer has purchased, in the example on page 7.7, the taxpayer has purchased a 5-year asset, all right, with a cost basis of $15,000. Now remember that cost basis means the cost of the asset required to put the asset in use. Okay, so that could include the cost of the asset itself. It could include, any sales tax that was paid on the asset. It could include any fees that were incurred in order to be able to use the asset. Okay, all of these costs are capitalized and are added to the value of the asset, of the hard asset itself. Okay, so we have a 5-year asset. All right, the first year in the example in 7.7, the first year is 2017. So if you were recording this, okay, on a fixed asset register inside your tax software, okay, on my software it's called a depreciation worksheet. On other software it might be called something else, but they're all basically the same thing. You have one form on the screen, and that's the form that you type in the asset itself. All right, so if I was buying a car, let's say I was buying a 2017 Toyota, all right, I would type in Toyota, 2017 Toyota as my asset. Okay, all right. In this case here, the person paid $15,000 for it. You can put in whatever day you actually got the asset into the tax software, but the computer is going to calculate it as if you had purchased and placed that asset in service on July 1st, 2017, which is the midpoint of the year. Okay, so then what we do is we go to page 7-8. We look under the 5-year column, and right underneath 5-year it says 200% declining balance. All right, 200% declining balance. Okay, so if you took financial depreciation, okay, you would know that the percent for a declining balance on a 5-year asset is 40%. What you do is you take 100%, you divide it by the number of years in the life of the asset, which in this case would be 5. All right, so 100 divided by 5 is 20%. Okay, but it's double. All right, declining balance. How do I know it's double? Because it said 200%. 200% is the same as 2. 2 is the same as double. So 20% times 40%. All right, I'm sorry, 20% times 2 is 40%. So that would be the percent of the rate of depreciation for the first year. But remember, this is a half-year convention. We're putting the asset in service in the middle of the first year. So we take that 40%, we divide it by 2, and that's why it says 20% for year 1. Okay, we would do the same for the remaining years. The one thing that you will notice about the table on page 7-8 is that 1 year is always added to the number of years that you have for the class life. So if you think about it, if you bought an asset in 2017 and you placed it in service on July 1st, 2017, according to makers, that means you're depreciating this asset over 6 calendar years. All right, it's still 60 months, but those 60 months stretch over 6 years because you have 6 months in the first year, 12 months in the second year, 12 months in the third year, 12 months in the fourth year, 12 months in the fifth year, and then you have 6 more months in the 6th year for the total of 60 months. Okay, so what you would do is you would use the applicable percentages on page 7-8, use them times the cost of the asset, which in our case was $15,000 on page 7.7, and that gives you the depreciation for the current year. And you would do that for every single asset. All right, so if you have a 15-year asset, all right, if you go to page 7-8, if you had a 15-year asset, you would depreciate 5% of it, okay, 5% of it in the first year. All right. By the way, also you probably noted, if you looked at the formula, all right, at the bottom of page 7-5, all right, it says depreciation is cost divided by the estimated useful life. All right. One thing that, again, the IRS assumes no residual value. No residual value in 100% business use. So if you do have a residual value, or if your percent of business use is less than 100%, you would have to note that in the depreciation worksheet when you type it into the software. Okay, we'll continue this discussion in the next video.